June 7th is here, the day you all had circled on your calendars, I know. Why did you have it circled? Because it was rate announcement day from the Bank of Canada. Our boy Tiff, who is featured in the thumbnail for a second week in a row, came out swinging today. 25 basis point rate hike. What does that mean for the real estate market in the GTA? We're going to get into that right after I introduce myself. Hey, everybody, it's me, Rob Marsiglio, sales representative with Keller Williams Referred Urban Realty, serving the great people of Durham region out here. Today, it's kind of a rates video. We're going to talk about the 25 basis point hike, what that means for affordability going forward, and kind of some indicators we're seeing in the market. Things already slowing down. Is this going to slow them down even more? Right into the announcement here, and I'll try not to do too much reading this video, but Bank of Canada raises policy rate 25 basis points, continues quantitative tightening. And what's important from here is that a couple snippets. Canada's economy was stronger than expected, so we talked about this in last week's video, with GDP growth coming in at 3.1% for the first quarter. Consumption growth was surprisingly strong as well, even accounting for a boost in population. Demands for services continued to rebound. In addition, spending on interest-sensitive goods increased, and more recently, as we've also talked about, housing market activity has picked up. The labor market does remain tight. Higher immigration and participation rates are expanding the supply of workers, but new workers have been quickly hired, reflecting continued strong demand for labor. So overall, excess demand in the economy looks to be more persistent than anticipated. And based on this accumulation of evidence, Governing Council decided to increase the policy rate, reflecting their view that monetary policy was not sufficiently restrictive to bring supply and demand back into balance and return inflation back to the 2% target. They wrap it up by saying Governing Council will continue to assess the dynamics of core inflation and the outlook for CPI, and they'll be evaluating whether the evolution of excess demand, inflation expectations, wage growth, and corporate pricing behavior are consistent with achieving the inflation target. They do remain resolute in their commitment to restore price stability for Canadians. Thank you so much for your resoluteness, Bank of Canada. But I just ask, try not to just restore price stability from here. Maybe if we can make things a little cheaper for everyone, that would be great. So we touched on last week's video about how this interest rate hike, if it did happen, would affect variable rates directly. Across the board, you're going to see variable rate products go up. But we also talked about how, because variable rates are already higher than fixed rates, it's not going to affect somebody's ability to qualify for a new mortgage. I mean, a first-time home buyer looking to get pre-approved or pre-qualified for a mortgage. This is that same chart from last week with TD, but I've added in kind of this change now. We'll see the 5-year variable rate hike up to about 6.7%. 5-year fixed rate increased 20 basis points overnight to 5.09% through TD. And again, this chart shows you that right after the rate announcement today, 5-year bond yields spiked. That is going to be what affects, or not affects, but it's tied to the 5-year fixed rate product. So I wouldn't be surprised to see fixed rates continue their upward trajectory as well. And that's what's going to really put the pinch on affordability. So not so much the rate hike, but the fact that, this is just one day. But here's looking back over the past 6 months, and you can see that we are back up to above our peak that we hit kind of in March of this year. So all in all, I think the rate hike will have more of a psychological effect on the consumer. You just hear rate hike, you think negativity, you kind of become a little more cautious. I think, biggest purchase of your life being a home, it's going to really hit consumers to say, hey, rates are going up, even though it may not directly affect their qualifying. Like we talked about, it's the fixed rate side that's going to affect qualifying, but just negative sentiment creeping in, talk about affordability, a pretty hawkish tone from the Bank of Canada in that report, I think will, negatively affect consumer sentiment. They'll look a little more negatively on housing, maybe not be so keen on jumping into a market right now. So I think that will be the effect of this rate hike, not so much the number itself. In terms of going forward with rates, this is the screenshot that I shared last week from the Montreal Stock Exchange, which kind of projects where we're going to be. So they weren't projecting that we'd get a rate hike June 2023. The chances were that we wouldn't actually see a 25 basis point hike, but we did. How did this update today after the rate announcement? Here it is this week. So, they're saying there's a chance that even from here, we could go up again another 50 basis points by December 2023, almost locking in that we'll be up another 25 basis points by next March, and before cuts start coming. I'm not saying this so that you look forward to cuts and I'm guaranteeing a cut coming, but like I said, this is a chart that does bounce up and down like a yo-yo, but it does give you kind of an insight as to what the market may be thinking in terms of what's happening with rates going forward. So that's all the rate talk I want to do. I feel like we do a good job discussing what is happening with the market on a weekly basis. So let's take a look at what was happening with the market prior to this rate hike and then try to project what it means going forward. First off is our weekly sale count and median sale prices of freehold residential resale properties across the GTA. So it's Toronto, Durham, York, Peel, and Halton. This is all per Trendly, which pulls data from the Toronto Regional Real Estate Board. So our black line here is the median sale price, and we can see that back to week 17, week 18, which is end of April, beginning of May, we touched 1.3 million 2 weeks in a row for the median sale price. And ever since then, we haven't bounced back up through that. So, prices, as you can even see with this orange dotted line, the 4-week rolling average is kind of rolling over a bit. So this is happening before rate hikes, okay? Prices were already maybe peaked and starting to come down a little bit as we got out of the spring market. Same thing with sales. Again, the sales numbers a little bit more negatively impacted by that long weekend week where we saw a big dip in sales in week 21 of this year. But again, that 4-week trend line, the 4-period moving average is what it is here, has started to roll over too. So sales already started coming down. Before you get to sales, you need showings. And as I shared on Twitter this week, follow me over there if you don't already, showings per new listing, this is a 3-week moving average that I'm using now, has actually started dipping since April. So there were less buyers per listing out there looking at properties before this rate hike happened. And remember, like I said, negative psychology, negative sentiment. I think that we'll see this slowdown continue even more as a result. Much the same as showings, this is offers per new listing. This faded line being kind of the year-to-date trend is what we've seen. So we've actually dipped below on the freehold side this trend line for the past 2 weeks. We've kind of been hovering at or just below it for the past 4 weeks. And the condo market has actually broken through to the downside of that average as well. Again, so less showings, less listings in Toronto, and a very similar story in the GTA. The slowdown in showings happened a little later. Really, it happened back here in Toronto. I think it's been a bit more of a defined drop-off since, end of April, beginning of May. On a showings perspective in the GTA, and in the offers, the same thing. Everybody's now broken down below their year-to-date average, including Durham, which still leads the charge. Durham loves to offer on properties. Again, if you remember my affordability chart that I shared earlier this week, it makes sense. It still is the most affordable pocket when you compare median income to median sale price. So maybe makes sense that Durham is still seeing some offers, but again, based on our rate hike, I would expect to continue to see these numbers trend downwards. You just have kind of a combination of seasonality, a slower summer months, combined with a rate hike. It's almost like the Bank of Canada paused at the wrong time leading into the spring market, and now they're hiking as things, they've already started to slow down. I'm not saying they shouldn't have hiked. It's probably a good thing to send a bit of a shock to the system, seeing what the housing market was doing, but I feel like we're already starting to see a bit of that slowdown prior to them coming in with this rate hike. As a recap, the rate hike happened 25 basis points. It's not going to have a direct effect on affordability or qualifiability, if you will, because again, variable rates are already higher than fixed rate products. But from a psychological sentiment standpoint, it's not positive. It's going to affect the consumer negatively, in my opinion. They're going to kind of back away. I'd say we continue to see price declines, probably sales decline, showings decline, offers decline as a result of this, maybe a little more rapidly than we would have expected heading into the spring market. To wrap up, I want to show you one more chart, kind of what I'm keeping my eyes on going forward in terms of when maybe this next price correction does happen. It's this chart here that compares the month-to-month percent change in months of inventory to the percent change in the average sale price. So I'm going to keep my eyes on for a spike in change in months of inventory, percent change in months of inventory, because you can see when this black line spikes, that's when we kind of see our biggest, most sustained price declines, which are these red bars, percent change month over month. So April 2017, we saw a massive spike in months of inventory, followed by a big correction for a few months. Again, April 2020, caused by the pandemic, people locked down, buyers not out there. So huge jump in months of inventory, saw a massive price decline month over month, bounced back pretty quickly, but still. Then again, April 2022, last year, kind of the start of the big correction, February through April of last year. But again, big spike with sustained growth of months of inventory. And that was kind of coincided with this big drop in average prices that we saw throughout that time frame. And that's why it's important to tune into Twitter every single Monday, where I will break down not just the number of months of inventory, but how it's changing, which I think is much more important, the rate at which it's changing, which will give us an indicator as to kind of what is going to be happening with prices going forward. That's all I've got for you this week. Thank you, Tiff, for the content. Again, follow me over there on Twitter for my weekly updates. I'll be back again next week, hopefully for week 4 in a row of videos. We're on a new streak, baby. I'm loving it. Until we speak again next time, please stay safe and cheers. Hey there, I really appreciate you watching this video all the way to the end. If you enjoyed it, I've got another video for you right here on the screen. And, while you're here, maybe just click on my face, subscribe to. I don't want you to miss anything going forward.